All right, welcome everyone. Thank you for joining us. Aspire Property Management and Walker Wayland are very excited to have you with us tonight. I'm joined by Kirit Lal. Kirit is a director and accountant at Walker Wayland. Kirit specializes in tax planning, minimization, and property accounting. I'm a customer of Kirit's. He's been doing my accounts for the last 2 years and he's made some excellent improvements. Welcome to the webinar, Kirit.
Thank you, Mike. Excellent introduction. Thank you very much. Really appreciate it.
No problem. Well, let's get started then.
Fantastic.
Okay, so just some housekeeping to start with. Kirit and I cannot hear you, but you can interact with us using the Q&A button down on the right-hand side. And we've done a bit of a sound check on this end and our sound is working. So if you have any problems with anything, it could be on your end. All right, so we'll start with an overview of the new policy and why we think the changes were made. And then we'll get into the bright line changes, the interest deductibility changes. I've then got an example of one of my investment properties, so you can see how these changes will affect me over the next 5 years. And then Kirit and I have put some examples together based on your questions, and Kirit will be giving his thoughts throughout. Finally, we'll finish with some Q&A time. So here is the new policy from the government. They're increasing the income cap so that more first home buyers can make use of the loan and grant schemes. They're trying to level the playing field between property investors and home buyers by adding in a capital gains tax and removing investors' ability to deduct interest payments. They're also making it easier to develop new homes through a $3.8 billion fund, incentivizing investments in new builds, effectively by excluding them for a set period for the capital gains tax and the new rules above. They're also implementing an apprenticeship program to help with the affordability of labour. Kirit, what did you think of the new policy?
I think it actually took a lot of us by surprise. The 5-year bright line test extension to the 10-year one was possibly very much expected, but the rest of it was actually a bit of a surprise. So, yeah, they are trying to actually go in the right direction by making these changes, but I think their unintended consequences are yet to be seen. So it's going to be interesting what's the space.
Okay, and you think some of these changes might be a bit misguided, going after property investors so single-mindedly?
Oh yeah, most definitely, because what they have done is that they've now made a whole new category of taxpayers, which are property investors, and they've put everybody in this area called property speculators, and they're trying to make sure that every property investor is called a speculator, and then not trying to actually get the most amount out of them as far as tax is concerned. So whether it's interest deductibility or a bright line test. So once again, that's a bit unfair because you could actually go out and get any other investments out there in today's marketplace, whether you want to buy shares or you want to go in and get commercial properties or anything else. The rules are the same, but unfortunately, now if you're a property investor, the rules are very different to everybody else's. So, yeah, how does that work? We're probably the first in the country for this, in the world.
Okay, all right. Well, let's have a look at what they are trying to achieve. So, effectively, they're trying to stabilize house prices, improve home ownership, discourage speculative investment, increase the housing stock with affordable homes, and then they're closing a supposed tax loophole. So in this session, we'll focus primarily on these 2 items as they will cause the most impact to property investors. And that's the removal of the interest deductibility and the extension of the bright line. Kirit, what did you think when you saw these changes? Were you like Macaulay Culkin in Home Alone?
Oh, very much so. I think we were only given a 30-second notice before the announcements got announced on TV, where everybody said, where did this come from? So it was completely out of it. They expected, especially the interest deduction one. As I said before, the extension of the bright line test, we all knew that it was going to happen, whether it was from 5 years to 7 years or from 5 years to 10 years. The writing was on the wall. It was going to happen, but the interest deductibility one, wow, it just basically shocked the whole market for everybody from real estate agents to professionals, accountants, lawyers, even developers, because now they're actually looking at you say, hey, this is the best thing that we've done to become a developer instead of a general passive property investor.
Right. So if people were caught off guard by the changes, particularly around the interest deductibility, that's completely understandable because there was just no warning at all. Is that right?
Oh, absolutely no warning as well. And it was against everything that the tax working group had previously recommended to the Labor Department, Labor government. So, yeah, for what it was, they didn't follow anybody's recommendations and went for something completely out of the ordinary.
Okay, let's have a look further into this then. So the changes to the bright line for rental properties purchased on the 27th of March 2021 and after, it's extended out to 10 years. New builds are only subject to 5 years. However, what a new build is has not yet been defined. So is that an accurate summary, Kirit?
Oh, very accurate summary. I mean, they haven't come out with the details at all. And one makes you think as to why is that the case? Are they trying to hide something? Are they now very much confused as to, after making all of these policy announcements, that what they're going to be doing as to what the law should actually be versus what they have said it's going to be? Or are they actually trying to prove a point by creating a bit of a shake-up in the property market by not releasing the rules and then waiting for people to say, hey, look at us, we are so good, that we've actually caused a bit of a shake-up in the property market and the market is softening. And it's only because that investors are sitting on the fence, just waiting for the rules and the definitions to come up.
Yes, absolutely. So
it may be all politics at the end.
okay, well, that will be interesting to see, and I touch on that a little bit later in the slides as well. This change of use rule that we've got at the bottom of the slide, is that a new rule or is that an amendment to an existing rule?
It is actually a new rule in its truest meaning. So previously, if you had a property and you had changed the use, you never had to prorata the sale proceeds against each other. Now, in the previous life, what the rules were is that if you use your home for 50% or more of the time, and if 50% of the area was used for your home, then proceeds of that property was not taxable, regardless of what you did eventually with it. But now with this rule, you've got to work out what how many years you actually stay in your home versus how many years you rented it out. And if you do sell it within the bright line test years, it is subject to this adjustment. So yeah, quite another sudden change that none of the professionals had expected.
Okay, interesting. So I've just done here a summary of the bright line dates, and it comes down to the date that you purchased your property. So on or after the 29th of March 2018, you're under a 5-year bright line. On or after the 29th of March 2021, you're under a 10-year bright line rule. Kirit, with some people being under the bright line now and with the interest deductions coming away, do you see people being caught out with their investments?
Well, I think, with most of these things, you got to actually look at the bigger picture. So people just do get nervous to say, hey, last year I couldn't actually get my losses being deducted against my other income because they had ring-fenced the rental losses against that. This year they've come with an interest deductibility problem. They've extended the bright line test. Are they really targeting residential property investors? The honest people who have saved for so many years and are trying to have a comfortable retirement. We are now targeted, and does it mean that we've got to exit the market? The answer probably to that question is no. If you do your homework well, and if you can make sure that you are changing things, and we will discuss that later with one of the properties that you have, Mike, and we'll show an example to say, hey, why it may pay to just block yourself from all of the media news, etc., and focus on your core goals.
Perfect. Excellent. Okay. All right, so on to the removal of the interest deductions. So the removal of interest deductions for properties purchased after March 27th, 2021, that's effective from October 1st. Everyone else's interest deductions are phased out over 5 years. So you can see the table at the bottom of the slide that shows the percentage of interest you can claim. It's not the key thing to sort of look at is that it's not a large change until the 1st of April 2023. We also have an election in March 2023. There's also an exemption to new builds in order to incentivize investments in this area. The details of what a new build is not being confirmed. Is that correct, Kirit?
Yeah, very much so. We're still waiting for the details. What is a new build? And we'll identify some potential issues with the definition of new builds because it can go all sorts of different ways. So, yes, the definition of a new build has not come out yet. So, what's the space?
Okay, so effectively, if the new build rules are not available, how can an investor make an informed decision on their next investment? Has this effectively frozen investors out of the market?
Well, this is one of the reasons why the property market has softened in the month of April is because investors don't know what the rules are, what the laws are going to be. And hence what they're doing is they're still holding on to the money that they could invest. And, when you talk to the banks, etc., they're still busy. They're still evaluating so many credit applications at the moment that they're inundated with all of the requests. But what is happening is that investors are now sitting on the fence and saying, hey, can we, do we know what the definition of a new bill is? Is it something which is going to be made after the 1st of April 2021, or is it going to be something which is 5 years old? What is the definition? We don't know. And this is where a lot of the investors are sitting on the fence. But if you look at this particular interest deductibility thing, the main impact of this thing possibly comes to a taxpayer investor after the 1st of April 2023, which is the 31st March 2024 financial year. Yep. And the tax payable on that is actually the 7th of April 2025. So you're talking quite a long time.
So the 50% threshold, you wouldn't pay the tax until 2025 for that 50% marker. Is that what you're saying?
Yeah, correct. The 7th of April 2025. So, that is quite a bit of time to plan ahead for yourselves.
Yeah, there's a lot of water under the bridge between now and then. You touched on it earlier about the investors sort of having to sit on the sidelines, and I think we can all probably expect to see some articles in the Herald over the next 3 to 6 months saying that investors are out of the market, and that the changes have worked and that everything's not going well for property investors. And I think that will really be just because those people are sitting on the sidelines waiting to find out when they can rejoin when the new rules get announced. So has there been any indication at all of when those rules around what a new build is and what the deductions might be about when we could expect that?
No, unfortunately not. I mean, nothing has come across my table yet. It's actually quite funny. They haven't talked about it. They haven't gone in for any sort of consultation yet with the public guys in practice. So yeah, it's actually a wait and see game.
Okay.
I mean, when coming back a step, when the capital gains tax came out in Australia many years ago, they went through the similar sort of patch that we are going through, where the property market softened right away. People were thinking about whether they do invest into property or not. But eventually, you look at the Australian property market now. Look at Sydney. It's actually doubled or tripled, or probably even 5 times in some areas to where they were pre the capital gains tax. So there are definitely things out there that people just need to once again look at the bigger picture.
Okay, excellent. And then finally on this slide, the changes will not affect lending against your property for business use. So that covers off people borrowing against their rental property, doesn't it, for business assets or things like that? Was that right?
Yeah, very much so. So anything that you actually borrow against your residential property, say to go out and buy a business, etc., that will still be the same.
Okay, excellent. So we sort of touched on this earlier again, and it's just around the background. So the interest deductibility was done without a regulatory impact statement from the Treasury. And also the tax working group that was put together did not recommend these changes. Commercial banks are split on the effect. Kirit, what have you heard about this, and what do you think the effects of this will be?
Yeah, I mean, once again, the commercial banks have been taken in surprise as well. All of the main 4 bankers, they didn't actually see this thing coming themselves. So it was a case of just knowing, what the changes are going to be, because as I said before, they still actually have their things happening. They're still getting all the credit applications through the system. It's a matter of time where they'll know which direction to go in.
Okay, excellent. Okay, so how will it affect you? So the capital gains tax, if you have to exit the market, ensure you balance the cost of remaining versus the additional cost of the capital gains if you are selling within the 5-year period or whatever your bright line period happens to be based on your purchase date. So any new investments you make should have a long-term goal of longer than 10 years, and unless you're willing to pay capital gains tax on them. There's also new builds may be a more favorable investment once the rules are announced. What do we expect to see with new build prices?
Yeah, I think that's going to actually go up. I mean, they were going up anyway because the cost of materials, the cost of freight are all going up. So now with this opportunity, the property developers are actually going to be laughing away to the bank because they'll take this as an opportunity to put their prices up again. Because if you've got an older house and now you can't get interest deductibility on it, you as a property investor would think about selling an older house and buying a new build. And all of the developers are pretty much hamstrung by the lenders with pre-sales. So if you can actually get if the property developer can get pre-sales from property investors, they'll actually keep doing more because the 4 main tier banks are going to be able to lend to them. So it's a win-win situation for the developers. But the property investors are going to be paying a little bit higher in prices as a result.
Okay. So the removal of the interest deductions, one of the things that sort of concerns me is the government's disingenuous language around speculators and loopholes. Kirit touched on this earlier, but property investors have now been singled out in tax law based on the nature of the business. This is not a loophole closing, but more a world first in reinventing the wheel from a tax standpoint. A Frankenstein tax system, is that a fair summary?
Oh, very much so, very much so. We'd probably be one of the first in the world to actually have something like this. So yeah, it's yet to be seen as to what the implications are going to be.
Okay, and also, so property investors will now be paying tax on profits that do not exist.
Yeah, exactly. So there's still a cash cost. So you've got to pay your interest, you've got to pay all of your other running costs of property. But unfortunately, the interest component part of it, you cannot claim that against the income, and therefore end up paying tax on that extra bit of money that has previously been claimed as a deduction, but now we can't.
Okay, look, I've always wanted to make videos for my customers, and this is my first one. I didn't think I'd be making a scary movie. Is there going to be a happy ending for property investors?
Well, I think, as I said before, if a property investor looks at the long-term game over here, they will definitely see that there could be a happy ending when it comes down to retirement. It's all about planning well and doing things properly. And I think we should actually go over to the example that you would have for one of the properties that you'd have, and
Okay.
how we can show the property investors that what would be the end impact in all of this.
Okay, excellent. Yeah, so one of the ways that I've sort of tried to think about it is I've decided to view this as a capital gains tax in advance, and I've just built it into my model as a cost that I've got to pay each year in order to stay in the investment. And another thing that I'm doing is I'm just bearing in mind again that it's not until the 1st of April 2023 that we get that 50%. And like you said earlier, we don't actually pay the tax for that until 2025. So we have a long time until that comes in. So that's sort of how I'm thinking about it. And then I'm also aware that, rents should rise out of this. We will see some landlords exit the market, and that is going to reduce the supply of rental properties, which will put upward pressure on the price. And then also every landlord in the country has been hit with a tariff, so to speak. So there'll be increased costs that landlords are going to pass on to their tenants. So I do see rents rising going forward. Okay, so on to the example of one of my most recent property investment. I purchased it in 2020. I will send out the original spreadsheet to everyone after the webinar, and you can enter in your own data. If you fill in about 8 cells, it will complete the 5-year projection for you. You can then adjust what you think the market for rent and property prices will do to see how it impacts your returns. I've made some assumptions in this table. I've done it for an interest-only loan. I've assumed a 2-year tenancy, and I'll include all those assumptions on the spreadsheet, but I just draw your attention to where I've got the laser pointer here. So you can see here, I've done the percentage of how much interest has to be deducted each year. So it starts at 12.5% for 2022, and then up to 25% in 2023, and then all the way along up to 100% in the tax year ending 2026. So I've just got all my income here, less expenses, and then I've got my interest cost here, and then I've taken out my 12.5% deduction for 2022. I've got two profit and losses here. One is the real profit and loss, which is under the old rules. And this one is the new profit and loss with my deduction taken off. So I've then also got my cash position at the bottom. And my cash position is my actual loss that I've incurred for the year, and then added on the tax that I have to pay. So that's given me $2,239.72 that I need to top this investment up. And if you follow that all the way along to the right, I've got the 5-year totals there. So I'm going to be looking at putting in $17,779 in order to maintain that investment. Down the bottom here, I've put in the property value and then the percentage increase for each year. And that totals up to $310,000 if the market goes up 5% every year, which is a cumulative percentage of about 26%. Which is well under the old 10-year rule of thumb. And then in the next slide, I've basically got my summary that for my $17,000 that I'll be contributing, I will basically get this gain of $293,000. So I'm effectively paying a 5.72% tax, which works out at $68.38 a week. So I won't be changing this investment at all. I think paying $68 a week to stay in this position is a good one. Kirit, have you got any comments about that?
Very good example. I probably could give you a desk at my working place. So the main thing with this is having a long-term game as a property investor. So this is fantastic. The other thing that we see with this is that if you are a property investor and if you are looking at the long-term gains in this thing, then it's all about managing your cash flow well. And as a property investor, I think we are all guilty that we do not run the property investments that we have as a business. And the main outcome in all of this is that we need to run it as a business. We need to make sure, and if you don't have the skill sets to actually run it as a business, you should actually get a good property manager, or employ somebody to make sure that they can do it for you, because it is worth the return at the end of the day, from all perspectives. So it's a case of, once again, nobody knows what the future is going to be, but if you look at, and you can only make decisions based on your current rules, if you do this, and if you hang on, and as there's been an indication on that table as well, that there's a general election between the March 2023 year and the March 2024 year, who knows whether the rules would be the same or not.
Okay, excellent. And just one last thing I wanted to draw people's attention to as well is I'm obviously under the 5-year bright line, and I've just done a row there that shows what capital gains tax I'd pay if I did decide to unwind my position there. You can see that it's actually quite a significant sum. Okay.
Perfect.
Well, you've covered off your thoughts on that, so I can skip ahead on that slide. And you're going to run us through some of those slightly more complicated issues that could come up with this law.
Yeah, so when you look at all of the changes proposed by the government, and they haven't really thought it through as to how the new rules will apply to a number of things. First one is actually the dual use, where you've got a commercial downstairs and a residential upstairs. The good old rules were that if you actually had the majority of the building with commercial was still being called a commercial, so you didn't have to apply any sort of apportionment in the interest rules. But now if you've got a commercial downstairs and a residential upstairs, what happens to your interest bill? Does it need to be apportioned? How do you apportion it? Is it still called a commercial, or is it now part residential? No one knows. The definition of the new build, what was it but before the rules? If you do actually make a bedroom, an extra bedroom on your old property, does that now get classified as a new property? What are they? So there are a number of things that the government has yet to actually define and think through, because the definition of a new bill is really going to dictate how the market will perform in the future and how the investors would react to it. If you demolish all your old houses and build a new one, does that actually get you away from the 10-year bright line test and give you the interest deductions? As we know, the general theme in Auckland at the moment is you get 1,000 square meter piece of land, you use unitary rules, put 7 or 8 houses on there. The average cost of one house after purchasing the land is about $400,000, including the piece of land. You sell it for 700, 800,000 in the open market, and that's where the property developers are making their money. When you look at, as a property investor, if you could build another house of your own for $200,000 today, and it comes under the interest deductibility rules, would you actually say that, okay, I'll go ahead and actually build a new place in my old site and go with the old rules? But the rules are not being defined. How would you do that? So as you can see, there are a number of things. The government hasn't really tested how the ring fencing losses actually would work as well, because in the March 2020 year was the first year that the ring fencing rules came into place, where people could not offset the losses against their income. So once again, what does this actually now do to us as property investors? We haven't still been told that if we do make profits from the new way of calculating income, which is not to account for the interest deductions, can we offset them against the ring fence losses, for example? Or are those ring fence losses really ring fenced? And up until we get a true profit, which is pre-interest, or when you don't have interest, that's only when you can offset this. So as you can see, there's a number of things in here that there are some possible issues that people haven't really thought about. And maybe the government even hasn't thought about as to how to put it in place and what sort of consequence it would actually create for them. So quite an eye-opener when you think about these sort of things as to what the final laws would come out to be.
Okay, and again, so these are all unanswered questions and still no sort of indication of when they will be answered.
Very much so. So no indication at all.
Yep. Okay.
Yeah.
That makes it easy for everyone, doesn't it? Okay, so onto the examples, and Kirit, you're just going to run us through this example here.
Yeah, so I thought it was quite important to just say what the implications are. If we had an example and ran it through, as far as somebody owning a rental property, and in this case, we'll say Jenna acquired a rental property on the 1st of January 2020 with a standard balance date. Well, her interest expense is $2,500 a month, which is $15,000 every 6 months. What impact would it have on the respective financial years? Once again, this is to highlight, to say that as a taxpayer, you would need to make sure that in this particular financial year, you remain a little bit astute, because as you will see in this example, in the 2021-2022 year, Jen is able to claim 100% of the interest charge between 1st of April 21 and 30th of September 2021, which is $15,000. Between 1st of October 2021 and 31st of March 2022, Jenna is charged $15,000 interest, but only can claim 75%, which means that in total, she can claim $26,250. Generally, what would happen is that when you're submitting information to your accountant at the end of the year, you summarize the interest paid as a lump sum number. And in Jenna's example, if she just gave in a number to say that I've paid $30,000 worth of interest in the year, and if there's no breakdown provided to the accountant, he applies a blank 50% rule in there, and technically now you'd only be able to claim 25% interest, 75% interest on the whole 26,000, but sorry, on the 30,000. But now if you have a look at this, you'd be able to claim 26,000. So instead of getting a 12.5% less deduction, you're going to end up with 25% less deduction. So quite important that as a taxpayer, you do keep a separate record this year of the interest charges that you have between April 21 and September 2021, because that is the period that you get 100% deduction.
So basically make sure that your accountant doesn't just put it all through at the new rate, so that you make sure you get the 12.5 and not get hit with the 25.
25, correct, exactly. Yeah. So quite important. Secondly, in the 2023 income year, you should only get a 75% allowance for your interest charge on the same thing of $30,000. Some accountants would actually just use the 25% reduction every year and may forget to apply that in that the 2023 year is the same as the last half of the March 2022 year. So, you don't want to get caught up in that. You're still allowed to claim 75%. So it's not until the 2024 year when it becomes quite plain vanilla that you can only claim 50% and the following year 25%, etc. So, and from the 26th year you wouldn't be able to claim any interest. So a big note to the property investors is that remain accountable and astute to your interest deductions, because you don't want to be ending up paying tax for something that you wouldn't be liable to pay tax for.
Absolutely. Okay, should we have a look at the next example?
Yeah, let's do that.
Okay, example 2, over to you.
Right. Now, in this case over here, Adam took out a loan to acquire a residential rental property on the 1st of April 2021. So this is after the tax changes have come through, but he can still deduct the interest being charged from 1st of April 21 to 30th of September 2021. A lot of people are in this mindset that if I bought something after the 27th of March, sorry, I can't claim any interest. But the rules say that you can actually claim interest from between 1st of April 21 and 30th of September 21. So please make sure that you do register, what your interest charges are somewhere so that they can get claimed.
Yeah.
So it's only after the 1st of October 2021 that that you cannot claim interest. In this particular example, Adam would be, disadvantaged.
Absolutely. All right, so I think we can get on to some of the pre-submitted questions. I've got one live question that I think we'll just start with first. What about a farm or lifestyle property? Do these rules still apply?
So that's actually quite interesting, because what happens is that there is a special provision at the moment for lifestyle properties and lifestyle blocks, where if you own more than 4,500 square meter piece of land in your lifestyle block, none of the residential rental property provisions actually come in. So it depends on the size of your lifestyle block. Is it 4,500 square meters or more? So, that answer will definitely be dependent on the size that you have and whether you fall under the category of residential property investment or as a commercial unit. So quite an interesting question.
Okay, excellent. All right, so we'll start with the ones that were pre-submitted. What are the pros and cons of moving from residential property to commercial as an investment?
Right, so generally you can rent out your home, if you're asking for the right price. So residential property is always easy to rent. Undoubtedly, it goes from day in, day out. If you're actually in residential property, all of your capital gains previously were non-taxable. Same thing applied to commercial as well. But what is actually going to become more attractive for commercial is that the interest deductibility will come through and you would be able to claim the interest as opposed to a residential property investment. But once again, owning an office block, owning a retail block, it's actually, it's not the flavor of the month at the moment. When you actually ask a lot of the commercial real estate agents, they are harder to rent out. Warehouses are actually doing well in the commercial space. People are wanting lots of things. But a commercial property investment is quite a different ballgame to being a residential property investor. A residential property investor is quite a hands-off thing. If you've got a rental property manager, you would not have to participate a lot. But in a commercial property investment, you would always have to remain active. Even though you've got a property manager in there, you would get all sorts of things like leases and market values and valuations and stuff like that. So it's actually quite a different game to play for.
The banks don't lend quite as much against commercial either, do they? And
yeah, that is true. So they have restricted down to about 40% now. So 40% equity, 60% lending, and also you need to have a background in commercial ownership, commercial property ownership. They would lend more to owner-occupiers, but not to property investors.
okay, excellent. Anyone thinking of adding to their commercial property portfolio? We do manage commercial properties as well. Never miss the opportunity for a plug. So second question here we've got is, are ERA break fees on fixed mortgages able to be processed as a tax deductible expense?
Well, it depends. So once again, you've got to satisfy the nexus test of assessable income versus deductible expense. So if you were in the business of renting out property and you were breaking out a mortgage, you could actually get a deduction for a break fee. However, if you actually have had it as your private home and you've come across it as a private investment and you're trying to claim a deduction for a break fee, the answer would be no. So so it depends on individual circumstances.
Okay, perfect. If I buy a piece of land and relocate a house onto it, for example, a house that has been removed and standing empty on a yard, does that count as a new build?
Yeah. So the definition of a new build has not been defined yet. So this is one which is going to be watch the space, because we're yet to know what the definition of a new build is. And if we can do this, I think there would be a lot of people getting into those house removals and putting up houses in the empty pieces of land.
Absolutely. Yeah, we got a lot of questions around the new builds and what was a new build. So it's definitely a hot topic at the moment. If a property becomes a rental for the first time today, does it get the 4 years of phased deductibility previously owner occupied? So I'm guessing that they've purchased it a while ago and they want to make it a rental property tomorrow.
Yeah, so the rules are based on the purchase date of the property for interest deductibility. It's not when you actually start your business. So I would say that, yeah, most definitely you should be able to go for the phased deductibility in this case, because you have to prior to the introduction of the rules.
Okay, perfect. And if I have to exit the market, are my agent's fees, so that's my sales agent fees, deductible from my capital gains tax payment?
Once again, the nexus of income versus expenses. So if you're a property investor and you have rental income and expenses, you would naturally claim any sort of exit fees as your deductible expense if you're trying to go with the bright line test. Yeah, so agent fees normally would be deductible in that sort of a scenario. So yeah, why not? And there is actually, if you look at the form for Brightline, which is the IR 833 on the IRD side, it actually gives you what are expenses that could be claimed as a deduction, which they call incidental expenses.
Okay, I had just on a side note, I have a question here from Robert saying, is there any provision to take into account costs towards maintenance or any other expenses incurred within, say, the last 5 years when allowing for the calculation of the capital gains tax? I guess he's asking if there's anything else that can be deducted off the capital gains tax bill.
Yeah, most definitely. So any sort of cost that you have incurred in improving the property, they all could be part of your Brightline test calculations.
Okay, perfect. Well, that's good to know. And what rate of tax do I pay on the capital gains tax?
Well, New Zealand doesn't strictly, in its truest meaning, doesn't have a capital gains tax with a specific rate attached to it. So, unlike Australia, where they've got specific rates for capital gains tax, depending on how long you've had the property, whether you're a resident or a non-resident, etc. New Zealand actually taxes any gains of income, whether it's of capital nature or revenue nature, depending on how you do. They all get taxed at your marginal tax rate. So it's just like another tax on income. So it's at whatever rate you are at, as far as the income is concerned.
Right. I did here on a podcast that we're second only to Denmark and Spain with the actual percentage that people pay. So if you pay the full 39% capital gains tax, only Denmark and Spain in the OECD are ahead of us on that particular capital gains. Almost every other country counts it as a nominal, like a secondary income, and you pay like a reduced rate. So
yeah, that's actually quite interesting because, as I said, we're one of the very few countries that don't actually have a specific rate, and we have got to actually pay based on our income.
Okay. What happens if your rental makes a loss? Can that loss be recouped?
Once again, we've yet to actually see what the rules are, but generally all of the rental losses are ring fenced, and what you actually get through is that if you do have something which has generated profit from your rental, you should be able to utilize it against your loss. There would be a natural assumption in this, but we haven't seen the final rules.
Okay. And would this new policy be rolled back by a change of government in the future?
Yeah, that would be interesting. You know, I mean, the National Party has said that if it comes into government, and there are two sets of laws that they're wanting to repeal. One is the healthy homes laws, which has been put across to the landlords, which is a great burden, and the other one is the rules on interest deductibility. So yeah, it could well be a possibility. And as I said, our impact for taxation is not going to be felt until the year ended 31st of March 2024 for the interest deductions. And there's an election in that year, so who knows what could happen. So,
okay.
Very good question.
Right. Okay. So I bought a new build house in 2010 and I still own it. Has been rented out since. Am I liable to lose interest deductibility?
Yeah, so once again, a definition of a new build has not been determined. So, it well could be that any houses built from 2010 could be in the definition of a new build. So, and you wouldn't be losing your interest deductions. But what is a new build? We've yet to find out. So it's hard to answer that question at this stage.
Okay. And then the last question here is, will this law change make landlords sell their properties?
Well, it depends on how good the landlords are in looking into the future and what they're trying to do. Once again, they will be a cash flow cost in trying to maintain the properties as they go along due to losing the interest deductibility. However, the changes come across, and would have a definite impact on cash flow in the future years, post 31st of March 2024 financial year, of any significant amount. So if using your examples, if it's only $68 a week and as a landlord you can afford that, then why would you sell?
Yeah.
So I personally don't think that it's gonna cause a big flood of rental properties on the marketplace. But it will all depend on the definition of a new build as to what comes from. So once again, if I'm a landlord and trying to make a call about it now, whether I should sell my property or not, my thing would be is just to hold fire and let's just wait for the laws to come out.
Okay, perfect. And I've just got one more question here that's just come through. And it was, what stage of the purchase process triggers the purchase of the property in relation to the cutoff date? I did see it somewhere. So if we don't have the answer here, I can get it to you afterwards, Gabe. I think it was the date of the signed agreement or something, wasn't it?
Yeah, correct. It is the date of the signed sale and purchase agreement. So that's the date that it actually triggers it. And regardless of whether you've got conditional clauses attached to it, that's the date that the purchase of the property is being triggered from.
Okay, perfect. Excellent. Well, I've just got, sorry, I'll just answer this one as well. Sorry, Raj, the capital gains tax percentage was worked out on the income tax percentage that you pay. He was just asking what was the percentage. So it's
sure.
not
It's no specific number called the capital gains tax. So it is very much just what your income tax rate is. So if you've made a capital gain of $50,000 and if that's your only income, then you'll be paying less than 30% at your marginal tax rates. If you have made a capital gains tax of $250,000 and the property is under your name, then anything over $180,000 would attract tax at 39%. So it is on that stepped model.
Excellent. Well, that's all the questions that we have, and I think that's basically a good time for us to sort of wrap this up. So thank you, thank you everyone for attending, and thank you, Kirit. It's been a pleasure chatting with you tonight. Thank you for that.
Thank you very much, Mike. Yeah, and thank you all. And yeah, if there's any questions after this, please feel free to let us know, and we'll be happy to answer them.
Okay.
Thank you, and have a good evening.
Excellent. Thank you. Okay. Thank you, everyone. And I'll email out the spreadsheet and a copy of the slides as well. So thanks very much for coming along.
If you try to sit, I'll tax your